Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. We're just a couple of days away from rate decision day. Both the Fed, we've got the Bank of Canada holding press conferences through this week. Last week's inflation and employment report suggests a green light for rate cuts across the board. But questions surrounding how current political sentiment is shaping long-term Fed independence still remain. How might the markets react if rate cuts do resume on both sides of the border? And looking further down the line, will a change in Fed personnel result in a shift on how monetary policy is fundamentally conducted? Joining us here today to discuss how these key economic and market factors are contributing to asset allocation decision-making is portfolio manager and member of Fidelity's Global Asset Allocation Group, David Wolf. Welcome. Great to see you, David. Thanks for joining us here today.
My pleasure.
It's the beginning of an important week.
It is.
We will invite everyone to send their questions in for David. We'll put those to you. Let's start with the two decisions that need to be made in our country and across the border, which is more the central bank to the world. It's all in the bag at this point, is it not?
I don't know about in the bag. The Fed is going to cut rates. Bank of Canada is going to cut rates. Let's talk about the Fed first, which is the more important decision for markets, not just in the US, but in Canada and elsewhere, which pains me a little bit to say as a former Bank of Canada official, but it's true. So I don't think there's any question that the Fed is going to cut rates. The market discounting right now is for a 25 basis point cut, and that's pretty firm. There's a little bit of suspicion that we might get 50, but 25 is the... and one of the very interesting things, and I'm sure we'll talk about this extensively, is why the Fed is cutting. Right?
Oh, definitely.
So there's this standard approach, which is to say the labor market is weakened, so job growth has kind of trailed off into almost nothing. We've had a big downward revision to payrolls, unemployment rate is up a little bit. So by the usual growth inflation matching that to the level of interest rates, you would be cutting. But then you have what's quite new and challenging, shall we say, for many folks, including us, is we might call a political overlay, which is we know that the administration is wanting to put heavy pressure on the Fed to be easing policy, and that's everything from Trump tweeting about Powell, the newest Fed governor, it seems, Steve Miran, who actually
looks like he'll be sitting there to make the decision with it.
Yeah, it's unprecedented to have a member of the administration also as a member of the Fed, at least in modern times. On
loan, we've heard. I don't know if that's correct.
Ostensibly.
Yeah.
And, the trying to fire like Lisa Cook.
Right.
That pressure is clearly there. So for the decision Wednesday, and I want to talk about kind of the longer term implications of this as well, but for the decision Wednesday, if you're the Fed, you kind of have two ways that you can go. You can either indulge the pressure and say, okay, maybe you go 50, maybe you sound very dovish, and you kind of accommodate or appease that pressure that's coming from the administration. You can go the other way and you can say, well, the most important thing for us as a central bank is our credibility, so we have to be seen as resisting these calls for lower rates, which still means that you probably cut 25 basis points, but you sound very different. So there is some uncertainty surrounding the decision on Wednesday.
So, again, we'll sort of go further into this, but for your purposes, for the way you look at the markets, for the way you make decisions, this rate cut is a cut that, as you say, is sort of looks like it'll probably happen. It is going to be very important to how it is positioned for further, because it'll talk about how more rate cuts, should they come, will be made. Is that right?
Yes and no. So that's how people will take it Wednesday afternoon, and that's how the market will trade, maybe Thursday. The really important piece is if you look out over the next year, 2, 3 years, how are the decisions being made? Who is making them, and how do you balance this rate policy that's appropriate for the economy with the rate policy that the administration wants? And the two can be very different things. So maybe to illustrate in terms of how we would think about these things, particularly from a fixed income point of view.
Oh, good.
So usually the way that we're thinking about our bond allocations in the funds, and I'm simplifying here, basically say you project out the economy, what's happening with growth, implications for inflation, what does that mean for short-term interest rates, i.e. the decisions that the Fed is making, and then you cascade that, what does that mean for longer-term rates, the slope of the curve, credit spreads, and you can build a fixed income approach from there. That's still relevant, but it's not clear how relevant that is, because the other method of thinking that you have to take now is, okay, what is the probability that the administration is going to effectively be able to capture the Fed, and how long does that take? How far below appropriate are rates going to be driven? How much is the longer end of the bond market going to be very unhappy that rates are lower than they should be, and so bringing in inflation risks? And then how likely is the combination of the Fed and the Treasury, because a captured Fed is working together with the Treasury, how likely are they to come in and do something like yield curve control, or try to bring down long-term interest rates in the interest of mitigating the cost to the budget? So all of these things are things that a year ago you wouldn't have to think of, but that's arguably more important than the basic economic stuff. So it's something we have to think about. So I'm actually I'm interested in what happens Wednesday, but not that interested in.
Right.
What we're interested in is, if you look out a year, 2 years, 3 years, what is the Fed doing? Why is it doing it? And how do we not only make money out of that in the funds, but really protect ourselves in the funds?
To what extent, and what type of comment or direction could be signaled on Wednesday that would make you change an allocation, maybe not tomorrow or in 3 days, to treasuries, to be involved in the U.S. market that is maybe changing the way that they make their own decisions with it, and so the structure of the Fed.
Right. So maybe two comments there. The first comment is, I don't think there's anything they could do or say on Wednesday that would make me want to change anything.
Got it.
Because it may not be the same people 6 weeks later who are making those decisions. So they may change their minds, but
even that,
it's not, well, exactly, which gets to the broader point, which is everything that's happening in terms of this political overlay to the Fed, questions about independence, questions about the way monetary policy is made, et cetera, is unsettling. If you are a bond investor, if you're effectively funding the US government by buying treasuries. And so one of the things that we've done in terms of how do we play that is we take our ball and go home.
Okay.
And what that means is we've sold out basically of all of our US Treasury holdings in the funds for which I'm responsible, because there are a lot of other places that we can put fixed income money where we don't have these concerns about the path of policy and the implications in terms of instability in the macroeconomy. Canada is one.
Okay, I was just
talk about
Canada,
that.
Yeah, we will.
But even something like, so the German Bund market, right? You have a very entrenched fiscal framework. They're going to be borrowing more money for their defense, but it's still, their debt levels lower, et cetera. So there are lots of places that we can own fixed income that are not exposed directly to these questions that are going on in the United States. And maybe the final comment on this is, if we're doing this, you can bet there are a lot of other asset allocators around the world who are doing this, and that in and of itself is the kind of thing that's going to push down the value of the US currency and US treasuries and push up the value of some of these other markets.
That is absolutely fascinating, that the bond portfolio could actually change a little bit and is
changing.
It has already.
Yep.
So tell us a little bit about the Canadian opportunity. This seems like a moment. So it looks like Tiff Macklem will also be in a position where he has to cut. We've seen growth slowing in this country. We know that that's sort of baked into markets as well. What sort of concern are you looking for from the Bank of Canada governor when he speaks?
Well, first of all, to step back and look at Canada from a policy perspective versus in the US. I mean, there are a lot of things about Canada and the US that are really sharp contrasts at this stage, but one of them is just how the central bank is making decisions, right? So we just talked about the Fed, and there's the economic piece and there's the political piece. In Canada, basically the last thing that you worry right now is the political piece, because the Prime Minister is the former governor and my former boss, Mark Carney, who, if anyone knows the value over the long term of central bank independence, it's Mark. So you don't worry about political interference, you're just looking at the economics.
So it's not in the equation for that.
You're looking at the quote unquote ordinary economic stuff. So where is the economy at? Where is inflation at? And the fact of the matter is the economy has been soft, seems to have gotten a little bit softer. We have the unemployment rate a little above 7%. It troughed out below 5% a couple of years ago. You have the housing market is pretty much at a standstill everywhere. You had GDP print negative in the second quarter. We got some data.
Are we in a recession?
Well, we got some data. I think we've been close to recession, and do you want to call it or not, for a year and a half.
Okay.
Right? And the numbers are slightly positive, slightly negative, but I think we've effectively been close to recession, if not in recession, for a couple of years, right? And it really doesn't matter whether you call it that or not. That's been the effect of it. But in that context, and with the data having weakened off a little bit further, it's fairly easy for the Bank of Canada to say, okay, we need slightly looser policy. So they'll do that on Wednesday. And it's a lot less interesting than the US decision. But for someone like me, I like not interesting.
Not interesting is good. Yeah, boring is good in this sort of area. But tell us a bit about where we get down to, because I mean, if we get down to 2% interest rates, there's not a whole lot of room to cut after that if we're in a position of, I don't know, some version of a crisis, right? I mean,
that's fine.
It is fine?
Yeah, that's totally fine. I mean, so the market
took a long time to get up off very low interest rates.
Yeah, I mean, so current rate is 2.75%. Yep. The neutral rate, as the bank would define it, is pretty close to that 2.75%. If you cut to 2%, which is roughly what markets are discounting right now by this time next year. Yeah. So that's slightly loose. If the economy falls out of bed, if you have a crisis, whatever, you go further. And we got obviously all the way down to almost zero. I don't think that's likely in virtually any state of the world, but you got plenty of room. I don't think that lower bound is at all on the bank's mind at this stage.
Okay, well, let's broadly speak about what that possibly could stimulate or at least catch the economy a little bit, but also taking a look at what appears to be an ambitious plan for build-out, government-led, over the course of the next few years. More interested in sort of how you see the environment for investing in Canada. You've mentioned in recent notes that you're sort of pivoting the ship back towards Canada. You're less negative on it, certainly. I think you're actually neutral on Canada at this point. You've always said
for the first time in a very long time.
For the first time in a very long time. And that you've always said you can afford to be very, very patient with certain types of investment. What does that mean today?
Right. So there are a bunch of different things in there, and
Patience in Canada.
Yeah, I'll unpack some of them, and then we can go for there. So first, with respect to monetary policy in Canada, again, boring, not that interesting. What's a lot more interesting, as you alluded to, is this ambitious agenda, particularly at the federal level, in terms of getting the economy going, getting productivity growth restarted in this country. And so we're looking a lot more at fiscal policy, and not just how much borrowing the government does, but what that money is being spent on in terms of expanding infrastructure, et cetera, ultimately the economy's capacity to produce, which is what drives those productivity gains and longer term growth. Now, you know, the Prime Minister, as I know personally very well, is a force. And if anyone can get through the red tape, bureaucracy, entrenched interests, et cetera, to get some of these bigger projects done, it's him. We'll see if even he can manage it, because there's a lot of headwinds that way, but we'll see. And our move back into Canada is going to depend very much on the success, particularly at the federal level, in terms of laying the foundation for that better economic growth over a longer period of time.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
So it sounds like, I don't know if it's a couple years out, but there's going to be some spending. There've been lots of announcements lately that is going to happen right now, and it's government funded entirely, and it's close to shovels ready type projects. They're happening now. Over the course of what it sounds like a couple of years, there's a major projects office, as you well know. That is the kind of stuff you'll be watching to see how that unfolds, because they are sort of there meant to get rid of red tape, frankly, and get things moving. That's part of what they're doing there. Is that process something that you're watching extremely carefully?
Yeah, no, absolutely. And it's not something where we're going to make a different decision today, tomorrow, next week in terms of how that goes. We'll see over time. But I mean, one of the important points you mentioned about patience. So one of the questions I've gotten asked quite a bit in recent months is, why are you moving back to Canada with your investments? Canadian economy may be in recession. The US seems to be doing great. US market has been on fire. Like, what are you doing? And the answer to that, again, is the sort of forward-looking and long-term approach that we tend to take. So Canada's current struggles were very visible many months ago. Right?
Like the mortgage 25, 26.
Yeah, the resets on rates, the headwinds from tariffs, which were very clear in the second quarter in terms of a big drop in exports, reduced immigration, and regardless of how one feels about that, those people spend, they work, and that's a contribution to the economy that's not there anymore. So you expected this to be weak. It was discounted by the market, amply so in our view. We're looking out a year, 2, 3, 5, 10 to say, how are things going to evolve going forward? So one of the things our colleague Mark Schmel likes to say is one of the times that you have the best investments is when things are really bad, but they're getting a little better. Right. And I think that's one way to think about Canada, where things economically are clearly not very good now, but there is a path to them getting better over time. Potentially much better, potentially a little better, we'll have to see. But what it means for us is, again, we've been underweight Canadian assets, underweight the Canadian dollar a very long time because the trend had been negative. And now things actually are not very good, but the trend is flatter to even slightly positive. And so we want to bring money back into Canada. And again, we're not dramatically overweight. That will take some time and evidence that things are going in the right direction. But it's been sensible from our point of view in the context of some improvement in the outlook, coupled with the deterioration in those US conditions, to move money back into Canada.
It's really, really interesting. Tell us just a little bit about your outlook for the currency discussion. You mentioned with Europe and taking a look at from a fixed income perspective and bond perspective, that you like being exposed to a currency that might well be going up, the euro itself, the U.S. currency, and really the Canadian currency, because you had quite a call on the Canadian dollar for a long time, and it was a bit dismal there for quite a long time. Where does it go from here?
Yeah, so I mean, one kind of big brushstroke way to think about how we've managed the currency is I came to Fidelity in 2013. Canadian dollar was close to parity. We sold it, a lot of it, and we bought it all back at 70-ish cents. So that's been a real win for our investors. And then where do we go from here? We're around 73 cents or so right now. I think the bigger story here is not Canada, but the US itself. So we have a strong view, both our group in Canada and our broader global group, that the US dollar is coming from an overvalued position and is likely to trend downward. And that's against everything. So euro, yen, sterling, Swiss franc, and Canadian dollars. So we've been trying to not only, as I mentioned earlier in the conversation, get out of US treasuries, but get out of US dollar assets, generally speaking. Now that doesn't necessarily include US companies, that many of whom are thriving right now, and we have those holdings. But generally speaking, broad brush, we want to be reducing our US dollar exposure. Now, why do we want to be doing that? It doesn't have much to do with what we were talking about in terms of the Fed decisions.
Okay.
It has a lot more to do with that political overlay, right? So one of the ways to talk about our view in the US is we think that there should be a higher risk premium associated with US assets because it's a riskier place. Things could work out great, things could work out terribly, and you're not being paid to take those risks right now. So, if Treasury rates were 150 basis points higher, if the US dollar were 20% lower, if the US broad market, so not the AI plays, but some of the tail of it was 5 PE points cheaper, we would still be involved in the US in greater size, but it's not. And if it gets there, we'll move money back into the US. But it's fundamentally risky. It also, if I may for a moment, it gets into what is the administration trying to do? And I think one of the things the administration in the US is trying to do is actually produce a weaker US dollar, even though they won't come out
through
and say
inflation?
That. Not so much through inflation, but so take the following premise, right? So you have a huge debt pile in the US, and that's mostly on the government balance sheet. So US government is highly indebted. How do you get out of debt? Well, there are 3 ways historically how a government gets out of debt. One is you default your way out, which you never have to do if you're the sovereign issuer in your own currency.
So that's not an option, really. Yeah.
You can grow your way out, which always sounds good, never really works. or you can inflate your way out, to your earlier point. Now, part of that inflation is just domestic CPI, goods and services, prices go up. But a big part of that inflation, when you have a lot of foreign debt, the way that the US does, is depreciate your currency. So you're basically giving dollars back to the people that lent them to you, dollars that are cheaper than the ones they
that
gave
are
to
worth
you.
less.
That are worth less.
Yeah.
Exactly. And in a sense, you're kind of stiffing your creditors, which is, it is consistent. I'll just...
So it's, okay. There's a gentle way of putting that.
Yeah.
As an investor, you don't want that.
I don't want that. And so we don't have that. And, yes, as I mentioned, we still have plenty of US company holdings,
Right.
US dollar holdings. One of my primary jobs as a multi-asset investor is to make sure that we're diversified and not owning anything in the largest economy and market in the world would not be diversified. So we have plenty of US holdings, and don't misunderstand that. But in terms of our active process, where do we want to be tilting? For many years, it was into the US and out of Canada. Now it's more out of the US and into a lot of other countries, including Canada.
That is fascinating. Okay, we're going to swing back to that. There are a number of questions that are linked to today's headlines, because there are a lot of headlines actually coming out today. One of them is, it looks like an increasing trade discussion between China and the US. Just park that for a second. This question is, any thoughts on the US pushing, and this is just a social media post from the president right now, it's not necessarily policy pushing, but
is
any
there
thoughts
a difference?
on you? That is for you to answer. US pushing for semi-annual reporting rather than quarterly reporting. I mean, actually, President Trump did push for this when he was first in office, didn't actually go anywhere. Maybe just give us some context for why that would be good or very bad.
So semi-annual reporting of economic data
no,
or
of
companies? Or?
He's pushing for it to be not quarterly and to just be every 6 months.
Okay. So maybe we would fit that into the broader conversation, including the economic data, because we know
Political
that
overhang.
he was not happy with the BLS and replaced the head of the BLS, and that's caused questions, understandably, from everyone as to the quality of those data going on ahead. I mean, the big picture, what I would say, not just
For
that
but
social media post, and
yeah.
we'll see if that's policy or regulatory changes or not, et cetera. But if in a modern, high-functioning financial market, the currency is information, right? And to get the highest valuations that you can out of a company, out of whatever, you need to have the best, most reliable, most transparent information that you can get. And things like, well, we're just not going to tell you, we're going to tell you half as often how we're doing, or maybe you can't believe these payroll numbers. Like, that all goes in the other direction. Right?
There's a
That's what
transparency
happens.
question there.
Well, yeah. I mean, investors want and deserve, and we are investors, the best information we can get on which to make decisions. And that seems to be going in the wrong direction, frankly, in the United States. And again, it's wrapped up in this concern about a risk premium that, let's take the extreme. If we never had any information about anything, how excited would we be to invest in something? Not that excited.
Well,
so that risk premium needs to be there.
You go to that, no data, no problem, right?
Maybe for others. And you know what? If there are other investors that are content in having zero information and are going to pay up for securities, we'll sell them to them.
Right.
No problem.
Let's talk just a little bit about the idea of patience, because I want to come back to this and fundamentally see if I can get you to say anything about how you are thinking about investing in Canada. We have some clarity on some big projects, as we mentioned before, government funded. But moving ahead, like, what's of interest to those investors in this country that have pockets big enough to make real investments in essentially infrastructure in a new country where the fiscal taps are going to be turned on? I mean, Germany is also doing this. Europe is also doing this. What is of interest?
Well, there's plenty of interest. And it's one of the things that the Prime Minister has, and I think will continue to say, like, if we really get some of these big projects going, the returns to the private investors who will be involved alongside public money could be very large. The returns to the economy, which is ultimately why you do it, could be very large. All of that, though, will take a long period of time. So let's take the example of, so among the major projects, I think one of them I saw is expanding the port in Churchill. which seemed, and getting the rail line up there properly, et cetera, which seems like a great idea. So there are two ways that that's going to stimulate the Canadian economy. One, building it, because that's a lot of building, and that's a lot of capex, and a lot of jobs, and a lot of money going in, et cetera. And two, once you have that available, particularly in a world where the Arctic is more, should we say, economically viable, that could be a real boost in terms of the strength of the economy, certainly in Northern Ontario, Northern Manitoba, et cetera. But more broadly for Canada, that could be a really big deal. But that takes a long time to manifest itself. Okay. So, I'm sure many folks will wait to see kind of the whites of the eyes of stuff actually put in place, actually earning a return to investors, to the economy, et cetera, and that's fine. But again, the way that we're set up with a very long-term approach is, if we wait for the whites of the eyes, we will have missed a lot of the value. Okay. We would much rather be involved in a project like that, and frankly, in an economy as a whole, when, as I mentioned earlier, to quote Mark, things are bad, but they're starting to get better.
Right. Okay, that's fascinating. There's a number of questions coming in. Let's go to this one. It has to do with the Bank of Canada. Ultimately, Bank of Canada lowering rates, the impact longer term on fixed mortgage rates. We are in the midst of these years, as you mentioned, 25, 26 of the mortgage reset. So how do you answer that?
So lower Bank of Canada interest rates, other things equal, and I'll use the economist term, tend to mean lower fixed rates, and that can be 3-year, 5-year, beyond 5-year, et cetera. The other big influence, maybe two big influences though, are one, what's happening in terms of fiscal policy, spending, and bond issuance. Right. So if you think about it, even if Bank of Canada rates are at 2%, if the government is borrowing a lot and issuing a lot of 5-year bonds, right, those rates in the 5-year space could actually move up if lower, shorter-term interest rates are moving down. The other issue is there tends to be something of a tether between Canadian 5-year yields and US 5-year yields. Mm-hmm. So if the US market gets very unhappy with politically compromised inflationary policy and US rates start to go up, that's going to tend to tug Canadian rates up.
Okay, so that's an example of where something that goes on in the US and it drags Canada along with it.
Yep, and there will be things like that, and we can't avoid it, and we would like to, and we don't get to make the world that we live in, right, et cetera.
You just get to invest in it. Yeah.
Well, but to the core question of what happens to fixed rate mortgages, the answer is it depends, but generally the more the bank is cutting, the better it will be in terms of bringing down those longer term mortgage rates.
So as we walk through this kind of fascinating week, central bank policy, of course, being written, new decisions being made, and so on, what would you leave with investors as sort of what you're making sure you look very closely at, and maybe just a little bit of a new regime out there that we're all traversing to different degrees? Yeah,
I mean, maybe my advice would be a stronger version of the advice I usually give, which is, don't get caught up in the day-to-day and the minutia and the next headline and what have you, because generally speaking, we try to take a longer-term approach. We're very patient with our capital. We know individuals are relying us to produce returns over a long period of time and not just a short period of time. So we try to kind of look through the noise, and that's good advice for anyone who's doing investing, particularly in this environment when things can be very different in terms of not only the decisions that are made, but who's making the decisions. Okay. That you really want to be not chasing what's happening in the near term and having that longer term view. That's something that's very important to us. And if we do have other investors in the market who are chasing the short term and again, willing to sell us undervalued securities or the reverse, then we'll take advantage of that for our clients.
Yeah. Okay, David Wolf, fantastic to have you here at this particular pinnacle. Thank you for your time.
Thank you.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.